Recently, we have seen that the term yen carry trade has gained much currency. Yen carry trade was responsible for the recent turbulence in the global financial market, including the financial market of US and India. Now, what is this yen carry trade? Where did it originate? What is the connection of this yen carry trade with the Japanese economic history? And what are the potential of this yen carry trade to further impact the financial market across the world? All this and much more we are going to discuss in the current episode of Simplified. Hello everyone, myself Shubham Raturi. Japan has always intrigued people. Japanese history, its culture, its people and economy has always been more than special. Simon Kuznets, the great Nobel laureate and the economist and statistician, when was asked about how to divide countries on different parameters, he said there are 4 types of economies. One is advanced economy. Second is developing economy. Third is Argentina. And the fourth one is Japan. So Japan has always been seen through that spatial frame by everyone, including the Nobel laureates. Japanese economic miracle, especially post-World War II, is something which was impressive. Now, in the very brief time period of 1950 to 1980, Japan has taken a huge leap on economic growth. If you compare Japanese per capita income in 1960s, it was just around $8,500. That is 1/3 of US. Whereas by 1988, Japanese per capita income was more than $35,000. That is more than that of US. So by 1988, Japanese economy was not only posing a danger and competing with US economy. In fact, for the brief time period, it overtook US also when we compare it in the terms of per capita income. So this was something which was Japanese economic miracle. That is, in a very short period of time, Japan was showing wonders. Now, there are 4 factors that were responsible for this impressive economic growth rate of Japan, especially after devastation that was caused to Japan post-World War II. And these were, first, the technological change. Now, technology was adopted increasingly in almost every kind of economic activity in Japan, and that too, very advanced one as compared to the standards that were prevailing then. Second was more and more accumulation of capital. Third, the increased quantity and quality of labor. That is, people were more skilled in Japan as compared to other parts of the world, and international trade. That is, Japan was using export as a very potent engine of growth. Now, these 4 factors are considered in academic literature are the most important factors for causing Japanese economic miracle. But there were also other factors that were working for the benefit of Japan. That was the deliberate policy of the Central Bank of Japan, that is Bank of Japan, to provide cushion to the Japanese economic sector. That is, following an expansionary monetary policy, a monetary policy where interest rates are low and money is provided at a cheaper rate to particular sectors of the economy. Now, this was called a window guidance. That is, Japanese Central Bank, that is Bank of Japan, was prodding and even nudging the Commercial Bank of Japan to fund specific industries in Japan so that they can be chosen as winners and can export massively from Japan to the other parts of the world. Now, this was something which was also behind the Japanese economic growth in this very short time period. And this was seen as a potent danger by US. In fact, Japanese products, especially its electronic products, its automobile, its steel, was almost capturing and flooding the US market. Now, US was very much concerned of this fast economic growth of Japan and losing competitiveness when it compared its economy with respect to Japan. Now, US tried to solve it in its own way. So, US called a meeting of G5 nations. Now, these G5 nations were United States of America itself, United Kingdom, Western Germany, France and Japan. Now, all the 4 countries apart from US were expected that they will appreciate their currency with respect to US so that US currency can depreciate and therefore US industry can gain some strength and competitiveness. It was something which was done by all the countries including Japan. Therefore, Japan appreciate their currencies as compared to the US. Now, Japanese yen as compared to the US was valued more. That is, Japanese currency was getting overvalued. Now, this led to something called a recession in Japan. We know that whenever the currency is appreciating or overvalued, it can pose a danger or it can cause the loss of competitiveness, especially of export sector. Now, this was something which was visible even in the case of Japan. Japan got something called Endeka recession. Now, Endeka recession is a term which is used in Japan, which means a recession caused by the overvalued yen. Yen, that is the currency of Japan. Now, this had to be countered. So, Japanese central bank, the Bank of Japan, started taking some measures. The measures were the normal, which is usually taken by the central banks. That is, expansionary monetary policy, reducing the interest rate, flooding the market with cheaper money. This was something they did. Now, when they did this time, the results were different. Now, what was happening? That inflation increased at a very high rate. In fact, economy started getting overheated. There was a huge increase in demand because the cheap money was flowing in the economy. And this led to almost a bubble-like situation in the stock market and the real estate market. The stock market especially was beyond its fundamentals, whereas real estate market was completely going mad and strange. If you compare the Japanese real estate market as compared to US and UK, you'll find that housing price index was increasing at a very high rate in the decade of 80s as compared to what it had been in US and UK. In fact, in the real estate, there were few things which were interesting and also surprising. For example, the whole Japanese real estate market was valued more than the US real estate market. To put this fact in perspective, I must tell you that US is 26 times larger than Japan in land area. Therefore, this was something which was bewildering. Apart from this, the value of the Imperial Palace of Tokyo was more than the Californian state of US, which is the third largest state of US. And on top of that, people were paying millions of dollars to get the membership for the golf club. So at that skyrocketing pace, the prices of this real estate in the Japan was increasing. That was something which was beyond the fundamentals. Now, this was something which was putting the risk of the bubble in the Japanese real estate and the stock market. Now, what happened? In the 1987 only, there was an episode of Black Monday in the New York Stock Exchange. So, New York Stock Exchange crashed and it caused crisis across the world. Now, people in Japan, especially the policy maker from the government side and even from the central bank side, started fearing that yes, something of this can also happen to Japan, and therefore they started taking action to burst this bubble in both the stock market and the real estate market. So they carried out the policy, especially from the central bank side, that is Bank of Japan side. The policies were completely reversal of what had been happening till now. That is, instead of expansionary monetary policy, now they started taking contractionary monetary policy. That is, to increase the interest rate and to suck in the excess money supply from the economy. That means to make money much dearer as compared to cheaper, which they were doing earlier. Now, because of this kind of policy, though Bank of Japan was able to contain and cool down inflation, but there was a cost to it, and cost was in terms of growth. So not only inflation was coming down, but even growth was stagnating. So a new kind of era started in Japan, and that era is marked by a word called lost decades. So this kind of lost decade, where not only inflation is being kept low because of a consequence of the contractionary monetary policy and the policy of bursting that bubble in the stock and the real estate market, but even because of that we have to pay the cost, and cost was in terms of lower growth. So both inflation and growth are stagnating. In fact, there was a time period where inflation also went to negative level. That is, Japan was experiencing something called negative inflation, which is otherwise called as deflation, and this was something which was turning the situation worse. Now growth was not only stagnating, this stagnating growth was getting prolonged for years and then for decades. Japan was in something called deflationary trap or deflationary spiral. This negative inflation, which is called otherwise deflation, is worse for any kind of economy. Now why we are saying that this negative inflation or deflation is worse for the economy? It is because it kills the motivation, it kills the incentives for the producer to produce more. It almost annihilates their animal spirits. So producers are not at all adding more capacity to produce and the growth is stalled. Now how it is actually happening? See, it works like this, that every producer is producing more and more things and selling them in the market so as to earn more profits. Now profits are not something which are unethical or illegitimate. Now if the price of the product that the producer is selling increases, the potential or the possibility to get more profit from that increases. But if something else is happening, that is something reverse is happening like deflation, where prices are going down, there will be a less of incentive for the producer to produce more, because if the prices of the product that the producer is selling is coming down, there is always be loss of incentive to produce more. Now if there is a loss of incentive for the producer, then definitely he'll take one of these two initiatives. Either the producer will shut down the plant or the producer will reduce the production. Now if the producer take any of these actions, these will be followed by two further actions. That is, he'll either lay off the employees, those who are working for him, and because now no more production or no increased production is required, or he'll cut down their wages. Now if we do any of these things, it will always lead to the loss of income for the employees that are working for the producer. Now if all the producers are working in the same fashion, that is, if all the producers across the economy are facing the brunt of deflation and therefore decrease in the price of their products, they all will respond in the same way. That is, reducing the prices of their products will be followed by either the shutting down of the production or lowering down of the production, or by either laying off the employees or cutting their wages, and therefore loss of income for the majority of the employees who are working in the production sector. Now if employees are losing their income, then definitely their capacity to demand more in the market will come down. And if this happens, if there is no money in the market, if there is no demand in the market, then definitely there is no sense for the producer to produce more. Now this is a kind of spiral and this is a kind of trap in which any economy, if it gets fixed or if it gets trapped, then it is very difficult for the economy to come out of it. And this is called deflationary spiral or deflationary trap. Now Japan was the victim of this deflationary spiral or deflationary trap, where prices were coming down but at the same time growth was stalled, because if prices are negative, then there is no incentive to the producer to produce more and there is no possibility to even increase the growth in the near term. Because this happened in Japan and has been studied more accurately with respect to Japan, therefore it is also called as Japanification of the economy. Now this is something which happened to Japan for more than 2 decades, especially from 2000 to 2020, and this is something which experts say that even China is at the risk of suffering. So deflationary spiral is something which killed and plateaued the potential of Japan for more than 2 decades. These 2 decades from 2000 to 2020 are called as lost decades for Japan. Now something had to be done to counter this deflationary trap, but they were not giving the desired result. But then something happened in 2012 when Shinzo Abe became the Prime Minister. He put the directed policy towards solving this kind of deflationary spiral, and the kind of strategy that he put forward to counter this deflationary spiral got the term called Abenomics, named after Shinzo Abe. Now this Abenomics got wide publicity across the newspapers, across magazines, across academic journals. Now this was a strategy which was based on 3 arrows. Now these 3 arrows of Abenomics were: first, expansionary fiscal policy; second, aggressive monetary policy; and third, the structural reforms. That is, in the first arrow of Abenomics, the Japanese government is going to give more of fiscal stimulus or going for more of expansionary policies, especially in the area of critical infrastructure. The second one was aggressive monetary policy, and this aggressive monetary policy was going towards having an expansionary monetary policy, that is again reducing the interest rate and therefore increasing the money supply in the economy. Now the problem with Japan was of deflation, that is negative inflation. Now you must be knowing that if there is negative inflation in the economy and if you have to increase prices, that we can do by infusing money supply in the economy. That is, if money supply is increased through some kind of expansionary monetary policy, then we can easily tackle the low inflationary situation. So to infuse inflation, we have to infuse money supply in the economy, and that was done through the second arrow of Abenomics, when the interest rate were brought down to very low level. In fact, for a time period it was even brought down to less than zero, that is negative. Means the central bank was incentivizing all the economic participants in the economy, including household, to not to put their money in the banks, rather than go outside, either invest the money or to create demand in the market so that we can uplift the economy. This was something which was done through the second arrow of aggressive monetary policy. Now the third component was of structural reform, that is reforming taxes, agriculture and business regulation so as to increase the prospect for the long-term economic growth of the country. So these three arrows together became the Abenomics and the three arrows of Abenomics. Now this was something which was expected, that by using these three arrows, Japan will be able to move out of the deflationary trap. It will be able to see some kind of inflation, and the target was at least 2% inflation and an increased economic growth rate. Now we know, because of the second arrow of Abenomics, Japanese economy was at a very low or even the negative phase of the interest rate. Now if you really want to see the things in perspective, you can see these two charts. Now you can see after 2000 the Japanese economy is experiencing a very low or even negative interest rate, whereas the Indian economy interest rate are far higher. So that shows you the relative interest rate that were prevailing in the Japanese economy and the Indian economy. Now this kind of differential of the interest rate of the Japanese economy with respect to Indian economy is not only seen only in these two countries, but rather it was something which was seen in many countries. So Japan, as compared to its peers in the world economies, was experiencing a very low interest rate, whereas the other countries including India, US, Australia, these were having relatively higher interest rate. Now this kind of differential or margin or carry led to something called yen carry trade. Let's declutter these three terms, yen, carry and trade first. Now yen we know is the currency of Japan. Carry, I already told you, is the differential in the interest rate in the Japanese economy, and that is prevailing in the other parts of the world. So that is called carry or margin or differential, whereas trade is simply trading of currency. So how these things are being put together? So yen carry trade simply means borrowing in Japan in yen at a very low or negative interest rate, and then investing in those countries which have relatively higher interest rate, for example India or US or Australia, and therefore earning that margin, that is the differential in the interest rate that is prevailing in Japan and in other country, as a profit. Now when these kind of things are happening in the currency market, this is something called yen carry trade. Now because it is happening in Japanese currency, that's why we are calling it yen carry trade. If it is happening in some other currency, for example, if suppose it is happening in US dollar, or if suppose it is happening in euro, and provided that the interest rate in the US and in the European Union is very low as compared to the other countries where this money that is borrowed in US and European Union is invested, then it will be called as US carry trade or euro carry trade. Now that is in brief the yen carry trade. Now we can sum up this whole basic idea of the yen carry trade in a simple phrase, that is borrowing low and investing high. That is borrowing in a country or in a currency which has a low interest rate, and investing in a country or in a currency which has relatively higher interest rate, and therefore earning the margin as the profit. Now this was a very important culture which developed in Japan over the time period. In fact, this culture has developed every time in Japan whenever there was expansionary monetary policy practice in the past also. So yen carry trade is not something which has happened only after 2000. It is something which has happened also in the previous episode of the expansionary monetary policy, because every time Japanese central bank was responding with expansionary monetary policy whenever it had to kick the growth in the economy, and therefore people in Japan, especially the housewives in Japan, were getting the incentives of borrowing in the Japanese currency and then investing in other countries or other currency which was having higher interest rate. So a particular pop culture started and people started saying that is a normal pastime of Mrs. Watanabe, that is housewives of Japan. Now let's try to understand how this yen carry trade actually pans out with some mathematical numbers. So again, we have two countries here. So we have one country that is Japan, and it has a currency that is Japanese yen, and then we have a country US, it has a currency US dollar. Then we also have two interest rate. One is a very low or negative interest rate, let's suppose that of Japan, and then another of US, which are relatively at a higher level as compared to Japan. So two countries, two currency and two interest rate. And these interest rate have some difference where US interest rate is higher, Japanese interest rate is lower, and therefore carry is getting generated, and this is a potential for profits by trading in these currencies. So how actually it is happening? Let's suppose the exchange rate of the Japanese yen and US dollar is 150 Japanese yen per dollar, and that is near about what the level is right now. Now let's suppose the person A, that is Mrs. Watanabe in Japan, is borrowing at a zero interest rate. Okay, and this was the rate that was prevailing at that time period. So at a zero interest rate, Mrs. Watanabe is borrowing 1.5 million Japanese yen. Now this 1.5 million of Japanese yen borrowed at zero interest rate, and when the exchange rate is 150 Japanese yen per dollar, will become 10,000 US dollar. So what this Mrs. Watanabe will do, she will convert these 1.5 million Japanese yen into US dollar. Now these are borrowed at zero interest rate, and then she will convert it into US dollar and invest in US market. Let's suppose the rate of interest in the US market is 4%. So what she is doing, she is earning 4% margin in this whole currency trade. That is borrowing at Japanese yen, converting into US dollar at a prevailing exchange rate, and then earning 4% interest for, let's suppose, 1 year. Now if suppose the exchange rate remains same, and that is a major assumption, I'll tell you why. And let's suppose after 1 year, when she has already earned 4% interest over 10,000 US dollar, we know that it will become 10,400 US dollar. Now she decided, let's bring back the money to Japan. So this 10,400 US dollar at an exchange rate of 150 Japanese yen equals to $1 will become 1.56 million Japanese yen. Now this is a 4% increase. Now in the whole transaction, we are discounting the conversion cost. Otherwise, there is also cost of conversion when you convert one currency to another currency. We are just assuming that is zero, again for mathematical simplification. So if the trade is happening in this way, this is called yen carry trade, and it has a potential to give some profits to people in Japan because they can easily do these kind of carry trade. But one major assumption that we have taken in this whole carry trade is that we are keeping the things as stand still. Rather, things are never stand still in the real economy or the real market. Real economy is quite dynamic. The interest rate can change. Interest rate in Japan can increase. Interest rate in US can decrease. And therefore, if either of these things is happening, the carry can get narrow. So the exchange rate of Japanese yen can appreciate, or the exchange rate of US dollar as compared to Japanese yen can depreciate. Both of them will again lead to losses, because when the Mrs. Watanabe will convert the dollars into Japanese yen, and if in the time period either the US dollar has depreciated or the Japanese yen has appreciated, both of them will lead to lower amount of Japanese yen as compared to the previous situation when we were taking things or numbers as stand still. So there are two important choking points or two important limiting factors. That is, interest rate should not deviate. Neither the interest rate in the Japan should increase, nor they should decrease in US, nor the exchange rate should turn adverse. That is, neither the Japanese yen should appreciate nor the dollar should depreciate. Now, if any of these things is happening, it can lead to panic selling. It can lead to turbulence in the financial market. And this is something which has happened this time in August of 2024, when people, especially the Japanese investors who had invested across the world and through the vehicle of carry trade in Indian market, in the US market and other Western market, they started feeling panic. Why? Because Japanese central bank started increasing interest rate, and at the same time Japanese yen also started appreciating. So they carry and possible profit starts getting narrowing down, and therefore they started panicking and started offloading their investment in the financial market in a very random manner, and this led to the turbulence and therefore downfall of the Nasdaq in US by 8%. Even India was impacted on that day when this thing happened. Now the question is that why Bank of Japan started raising interest rate? Have they solved the problem of inflation? Now the answer is more or less yes. Because in Japan, I told you, when Abenomics started, they were targeting just 2% inflation rate. Now this 2% inflation rate was something which was witnessed recently, and therefore Bank of Japan, that is Japanese central bank, started moving away from negative interest rate policy. Now this was the last bank which was following this negative interest rate policy, and when it started moving from the negative interest rate policy, it first increased the interest rate, that is the key policy rate in Japan, that is from minus 0.1 to first 0.10 in March of 2024, and then from 0.10 to 0.25 in July of 2024. This was a significant hike, and that too successively. This led to higher interest rate, narrowing margin, and also led to the appreciation of the currency of Japan, that is Japanese yen, further narrowing the margin, and therefore the response that was shown by the people, by the investor or Mrs. Watanabe of Japan, who were invested in the various financial market, and therefore the unwinding of yen carry trade. Now though the yen carry trade is unwinding, but the problem in the Japanese economy and even in polity are not over. Now Japan was in the deflationary phase. To come out of the deflationary phase and to infuse some growth, the money supply was increased through expansionary monetary policy. Now this later on, after 2 decades, gave some kind of inflation to Japan. But people are not very comfortable with this even very low amount of inflation. Why? Because they are very much now accustomed to a very low or even negative rate of inflation. When the prices are increasing, they are feeling the pinch because the wages are not increasing by the same rate, and therefore it is creating the political troubles. It was such a big trouble that it was one of the factors responsible for the resignation of Prime Minister Kishida. Now the problem is the Japanese economy cannot grow in a deflationary phase. People are not ready to accept any sort of inflation. So the government has to work on very tight rope. Both the government and the Bank of Japan had challenges in front of them. And at the same time, Bank of Japan is saying that they are going to increase interest rate so as to contain inflation. Now, if they increase the interest rate, and if they try to contain inflation, especially to assuage their domestic constituency and even to control inflation in the economy, that can lead to further unwinding of yen carry trade. Japan has already invested a lot in the financial market across the world. Therefore, the kind of turbulence that we saw in August of 2024 is something which can be expected again, and in fact in a much more monstrous way. So that was the discussion with respect to yen carry trade, and how it was linked to Japanese economic history or the economic policies that were practiced in Japan over the course of years and decades. If you want to see the similar kind of videos, you can check our playlist. Thank you for watching. We'll meet again with yet another episode. Till then, goodbye.